Let us understand now the classification of the mutual fund industry, such a vast industry with so much of funds. Let us quickly understand the classification. So what mutual fund companies do, they take money from you and then they invest this amount into multiple securities. Now on the basis of this objective or on the basis of the securities, there are around 11,000 schemes. By these 44 asset management companies, around 11,000 plus schemes. All schemes having a different focus, having a different objective. So what I have done out here is that I have classified most of the schemes that I have come across into particular 4 segments. But before that, let me understand what mutual fund basically is classified into. It is classified as either a closed-ended fund or an open-ended fund. What happens in a closed-ended fund? That the entry and exit is most of the time restricted. For example, you can buy the fund in the limited time period and you can sell the fund only after a limited time of period. Before that and after that, you cannot buy or sell. So what basically happens is that suppose the mutual fund comes out with an IPO. Now when we say when the stocks come out with an IPO, in the case of mutual fund, we say that mutual funds come out with an NFO. NFO is nothing but new fund offers. So when a mutual fund is first launched, when it first launches its scheme, whatever the scheme is, so a lot of people invest there, and then this particular fund is open up for a limited period wherein you can come and invest. After which the investments are not allowed. So that category of funds is called closed-ended funds, wherein even if you want to sell, there is a limited time period only after that maturity you can sell. We'll come back to the closed-ended funds because we have an entire topic dedicated to closed-ended funds and its valuation. Okay, now let's come to the open-ended fund. By the meaning itself, what open-ended fund means, by the name itself, that it is open for subscription, that is additional investment, or redemption, that is exiting the investment. I'll repeat, it is open for subscription or redemption at any point of time, at any day. There is no restriction in entry as well as exit. Such are the mutual funds. Most of the funds are open-ended funds. So what I'm going to do is that I'm just going to classify now this particular funds into various segments considering the assets. So we have equity mutual funds, we have debt mutual funds, we have a combination of equity, debt and other assets that are hybrid mutual funds, and then we have other category, the miscellaneous category of mutual funds. That is what I have classified. So quickly coming to that, I'll come to the equity mutual funds. In the equity mutual funds, there are a variety of investments that people prefer to. Some would prefer to invest into stocks which are of A group or high, ranking stocks. Now, how do I rank a stock? I rank a stock by not its market price, by not the size of the company or the company that is more in media. I rank the company, or I value the company, or I categorize the company as A group by its investment value, by its market value. So when I talk about market value, so market value of any company or market cap of any company is number of shares outstanding, that is number of shares outstanding into the current market price. For example, when I say TCS, Tata Consultancy Service, today it is one of the most valuable companies in India with a market value of 5 lakh crores. Follows then is Reliance Industries, which has around market value of 3.5 lakh crores. So on the basis of the market value, when companies are segregated as top 10 companies, top 100 companies, top 30 companies, top 50 companies, that becomes the company categorization on the basis of cap. So when someone issues a fund like HDFC top 200 fund, so it invests in the top 200. How do I mean by top 200? What is that top 200? That top 200 is top 200 stocks by the market value. So HDFC top 200, a scheme would invest in particular stocks which are in the top 200 category. So then you have large cap funds. This funds or this scheme would invest in stocks where the market value is higher. So it is so the market value is not defined basically what is higher, what is lower, but then the fund manager would prefer to invest in only those securities which are very highly valued. Then you come to the mid cap. These are stocks which are slightly lower valued than the large cap. Then you have the small and micro cap funds also, like DSP BlackRock micro cap funds or small cap fund or mid cap fund. So this particular three categories of funds would invest into the securities based on its market value. But then someone would prefer having a mixture of all together. So then you have multi-cap or diversified funds. So these funds do not invest based on the category, they invest based on the valuation mode. right? So then you have multi-cap funds. Then there are some people who are interested in investing in securities only specific to some sector like banking sector or infrastructure sector or pharma sector. So for them also they have mutual funds which are based to sector like Reliance Banking Fund, SBI Pharma Fund. So these are funds dedicated specifically to that sector and that sector stock. You have also this category of ELSS, that is equity linked savings schemes, wherein you get the tax benefit. So you invest in this category of funds, you get the tax benefit, wherein the lock-in is for 3 years, right? Then you have many other characteristics, many other features of the equity mutual fund. Of that, one I have taken is dividend yield fund. This category is more like a thematic or a sectoral fund, but they invest specifically into the companies which are high dividend paying, like NTPC or you have BHEL. These are high, PSU companies which pay high dividend. So they specifically invest into that theme of, stocks. So this is equity mutual fund, right? Most of the amount that we feel should be in equities, no, that is not a fact. So out of this 14 lakh crore, I can tentatively say that only around 3 to 4 lakh crore is in equities. Major amount is in the debt, wherein the corporates invest. So let us come to the debt category. So when I come to the debt category, what happens in the debt category? The first one is the liquid fund. So liquid and liquid plus. First of all, let me understand what is liquidity. A lot of you all must be aware that liquidity is something that is easily convertible to cash. What I'll do is that I'll just add one more word. Liquidity is easily convertible to cash, but at fair value. Okay. So what happens? Like you invest in saving banks. So you can put in the saving bank whenever you want and you can exit whenever you want. So suppose now if you have spare funds, what would you do is that you would put that spare fund in a saving bank account so that it earns interest. Even for a day or two, it may not be a big amount for your 1,000 or lakh rupee investment, but yes, it's a big amount for corporates and banks who have, spare funds to the excess of 30, 40, 50,000 crore rupees or 1,000 crore rupees. So for them, that one day interest definitely makes sense. So what they do is that they invest this amount in saving bank, traditional. Now the same feature is available with liquid funds and liquid plus funds, wherein you can invest in for a day or two or probably whatever time you want to invest. So these are tools much like saving banks. Why corporates invest here? Because they hold, the mutual fund companies here hold papers or investment securities which have maturity for a day or two, like call money market, repo. These are short-term money market instruments. So basically these are also called, if I were to notice, this section is also called money market mutual funds, which invest specifically into money market instruments. So this particular sector would invest into money market instruments depending on the maturity. So if you want to invest for very short maturity, liquid fund is an option. If you want to invest for slightly higher, that is 5 to 10 days maturity, you can invest in liquid plus funds or ultra short-term funds. Now this is a category wherein people would prefer to invest rather than investing in savings. So a major allocation out of that 14 lakh crore till today, even today, is into the liquid and liquid plus fund, wherein people put instead of putting that in savings account. Then you have corporate bond funds. These are corporate bond funds wherein corporates issue bonds. So like equity mutual funds, fund managers hold a portfolio of corporate bonds also. So you also get access to investment into those multiple corporate bonds through the investment into corporate bond funds. So here you have corporate bonds with a maturity of 3 to 5 years, which fall under the category of short-term corporate bond funds. You have corporates issuing bonds for more than 10 years, 15 years. That category is called long-term corporate bond funds. Then you cannot directly, as a retail investor, I cannot directly invest into treasuries because that is restricted to financial institutions. So then how do I invest into treasuries? Yes, there are mutual funds who are specifically given the permission to invest into the treasuries or T-bills or government securities. Such mutual funds are called gilt-edged securities. So they invest specifically into the G-Secs, government securities. So I basically get a flavor of everything to mutual funds. But here equity and debt, I am a bit averse that whether equity which is very risky or debt which is less risky. You can also have a combination of both, that is the hybrid funds. So in hybrid you have balanced mutual funds which invest around 65 to 70% in equities and a slighter portion in debt to take the risk balance. Similarly, you have MIPs, monthly income plans. These are more for the retired categories wherein they invest around 80 to 90% in debt, but just to cover the cost of inflation, they invest 10 to 15% in equities also. So that is the hybrid category. You have asset allocation category. These are a new form of funds wherein the fund manager would invest into debt, equity, commodities all together, specifically gold in the commodities, so that whichever asset makes more sense. These assets are cyclical in nature, so whichever asset makes more sense, they can invest there. right? Wherever they find out an opportunity. How would you come to know where is my fund going to invest? Yes, before you do any financial investment, you get a prospectus. In case of mutual fund, you get something that is called SID, scheme information document. So you must have heard that advertisement, mutual fund investment are subject to market risk. Please read the scheme information document carefully before investing. So that scheme information document or that offer document perhaps has the common objective, the objective wherein the fund is going to invest. So they do write that this fund is going to invest in large cap, this fund is going to invest in short term corporate bonds, etc., etc. This fund is going to invest in asset allocation, etc. Then you have other categories of mutual funds which are very interesting categories. The commodity funds. So this commodity funds would invest in agricultural commodities or precious metal commodities. This particular mutual fund would invest into the companies which are related to commodities. For example, there is Birla Sun Life Mutual Fund. So this fund would specifically invest into companies which are related to agriculture, like the fertilizer companies, like you have the tractor companies like M&M, you have the irrigation companies like Gen Irrigation. So these are companies specifically investing in the commodities and commodities related business. You have gold funds wherein people, instead of investing directly gold, physical gold, which is very risky, they would rather invest in paper gold, that is gold funds or gold ETF. What is ETF? Exchange traded funds. So exchange traded funds are replication of something. For example, you cannot directly invest in Sensex or Nifty. They are just an index. So yes, you can invest in their replication through exchange traded funds. So you have Sensex exchange traded funds, you have Nifty ETFs, you have gold ETFs. So exchange traded funds are also managed by AMCs, but yes, they are traded on stock exchange unlike the other funds. Plus you have global funds, like there was this Fidelity Global Real Asset Fund that I remember. There is ICICI Prudential US Blue Chip Equity Fund, which would invest in offshore funds itself. So when you want to have access to US markets, you cannot directly invest. You can invest through mutual funds which have access to investments abroad or investments or funds abroad. Plus, out of seeing so many categories, you may have got confused which category I should choose. So then there are fund of funds who would invest on your behalf in multiple mutual funds. They would make a portfolio of mutual fund itself for you. So this such large is the category of mutual funds. When I come to the closed-end funds, you have two basically categories. FMPs, that is fixed maturity plans. These are much like bank FDs. They invest in short-term papers where the entry and exit is restricted. So closed-end funds, the entry and exit is restricted. Then you have CPF, capital protection funds. These are specific structured products wherein your capital is protected, and that is the way they function up. So these are more of closed-ended funds wherein you may not find an opportunity to enter and exit after a certain point of time, right? That is where people mostly invest in open-ended funds, which are very much transparent and which have very much of liquidity, where to enter, when to exit. That is what they have. So that is the classification of mutual funds. You can have a look with the classification and then you can revert back to us.